Are you keeping up with the latest economic updates in the UK? Well, it's not looking great according to Chancellor Jeremy Hunt. Make sure to subscribe to the channel. Despite narrowly avoiding a technical recession, recent GDP figures show that the UK economy has stagnated at the end of 2022. And it's not just the UK that's being affected, as our neighbors in Europe are projected to avoid a slump this year with a growth rate of 0.8%. Even the Republic of Ireland is expected to grow just under 5%, boosting the area's output. Meanwhile, the US is unexpectedly adding jobs, leading to a potential recession avoidance. So, what's going on with the UK? Why is it falling behind? Stay tuned to find out. We, on the other hand, have been told to expect to shrink 0.6% this year by the International Monetary Fund, IMF, making us the only rich country to finish 2023 with a smaller economy. Even Russia is forecast to grow. Inflation has been the main factor kneecapping the world's top economies. Before we continue, it's important to note that the IMF's projections have a history of inaccuracies. However, the UK's economic struggle is no secret, with households and businesses being hit hard by the increase in costs, leading to cutbacks in spending and slower economic growth. The rise in inflation, particularly in Europe and initially in the US, was mainly caused by the steep increase in gas prices, as pointed out by economist Philip Shaw. Although the gas prices have stabilized now, the impact has already taken a toll on the balance sheets of families and businesses in Britain and Europe, unlike in America. The UK's reliance on gas for household power has amplified the impact on consumers and businesses, as compared to other countries. Moreover, Chancellor Jeremy Hunt's support has been less generous than his European counterparts, according to Dean Turner, chief Eurozone and UK economist. As a result, UK inflation has surpassed that of the US and Europe. So, what does this mean for the UK's economy? Let's dive in. Let's take a closer look at some of the measures taken by other countries to deal with rising energy costs. For instance, France's state-owned energy company, EDF, was forced to limit price increases to just 4% for most of 2022, while the German government paid household energy bills in December and implemented around PS 175 of support. In contrast, the UK government opted for a £2,500 price cap on energy bills, which has unfortunately failed to prevent skyrocketing energy bills for families over the past year. Although inflation in the UK has been cooling down for 3 consecutive months now, standing at 10.1%, it had surpassed the rate of price increases in Europe and the US throughout most of 2022. Consequently, the UK is expected to face a more significant decline in living standards, leading to a drop in spending. In comparison to the Eurozone, the US did not experience double-digit inflation, even though it peaked at 10.6%. Unlike some European countries, there was no energy cap introduced in the US. The inflation surge in the US was mainly due to excessive spending from President Biden's administration during the pandemic. However, the most significant problem for the UK is its diminishing workforce. Since the onset of the COVID-19 crisis, around 500,000 workers have left the workforce, which is unusual when compared to other wealthy countries that have seen an expansion in their labor market. The reduced number of available workers has led to firms increasing wages to attract and retain talent, resulting in a rise in domestic inflation. The UK's staff shortages have led to a reduction in output due to companies being unable to expand their operations. In contrast, the US job market is rapidly expanding, which is contrary to the intentions of Jerome Powell, the head of the Federal Reserve. While high worker demand may sustain inflation for a longer duration, it will also increase spending by keeping incomes intact. The Bank of England has adopted a more aggressive policy than the European Central Bank, ECB, but less than the US Federal Reserve. Since their first increase in December 2021, Bank Governor Andrew Bailey and his team have raised rates by a total of 390 basis points, resulting in borrowing costs reaching a 15-year high of 4%. Meanwhile, ECB resident Christine Lagarde has raised rates by 300 basis points, and the Fed chair has endorsed 450 basis points of rate hikes. The BOE and Fed are probably going to ease off the brakes soon, while the ECB is expected to back around 100 basis points of hikes this year. A steep rate peak in the UK of probably 4.25% is poised to be a clamp on growth this year, the IMF said in its latest forecasts. In fact, analysts at Goldman Sachs reckon every 100 basis point increase lowers the level of real GDP by roughly 0.5%, mainly by raising mortgage rates. One factor that has delayed the impact of higher rates on the UK economy is the large number of homeowners who switched to fixed-rate mortgages following the financial crisis. As a result, changes in interest rates have had less of an impact on the real economy. However, the issue of corporate borrowing remains a concern, particularly for small and medium-sized enterprises, SMEs. A significant portion of SME lending in the UK is on floating rates, which means they are more vulnerable to changes in interest rates. The return of austerity measures in the UK, including tax band freezes and levy rises, is expected to have an impact on production. These measures were announced in Chancellor Jeremy Hunt's November PS55 autumn statement, which sought to shore up investor confidence following Liz Truss's mini-budget. The 6 percentage point corporation tax rise is scheduled to be implemented soon. Frederic Carrier, head of investment strategy for RBC Wealth Management in the British Isles, said that the return of austerity, along with less support for the energy crisis, will play a part in choking production. Philip Shaw, economist at Investec, noted that Britain's fiscal metrics look worse than other European countries and that the UK government's need to tighten policy to achieve a sustainable fiscal position in the medium term is more pressing. It seems that the UK's tax and spending policies have become tighter, as tax band freezes and levy rises were introduced in Hunt's November 2022 autumn statement, including a 6 percentage point corporation tax rise. Hunt's biggest single support measure has been the £2,500 energy price cap, which is on course to jump to £3,000 in April. However, the recent collapse in energy costs has led to the policy causing a price spike rather than smoothing prices, according to the Resolution Foundation. To avoid a brief period where the price cap will be above the amount retailers would charge based on lower wholesale gas prices, Hunt is likely to delay the cap increase for 3 months to give wholesale prices time to feed through. The EU has urged countries like Germany, France, and Italy to roll back support to avoid reigniting turbulence in the euro debt markets. Additionally, tax rises and spending cuts are working with the Bank of England's aggressive rate rises to squeeze the economy.